Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. A lot of great topics to go over, a lot of companies to go over, but we're going to start off with no surprise to us that there's a glut of apartments on the market. We'll talk about that for you. Are the large hyperscaler companies like Meta, Microsoft, and Apple inflating their earnings? Ooh, we're going to dig into that for you. I know. Wait till I hear it. That's kind of amazing. China is no longer just a manufacturer. They also are beginning to innovate, and that's going to be a problem if we don't wake up and start producing a little bit more here.
Yeah, I mean, definitely an important thing, I think, as a country. We got to keep an eye on China.
Yes. Compete with China.
Compete with them, absolutely. Companies we're going to look at today, though, we're going to look at Axon Enterprise. This company used to be Taser. Yeah, you know, the tasers that police officers use. Yeah. But again, it transformed into a broader based, I'm going to say, kind of not a defense company, but really tools that police officers can use. I actually have a good friend that works there, and it's pretty amazing what they're doing. But also, too, we're going to look at Zoetis, I think is how you say it. I believe they were spun off from Pfizer. They're an animal health company. And then Elf Beauty and Sweet Green. As always, we will break down the fundamentals, give you an idea if we think it's a buy, sell, or hold based off the numbers we see.
Yeah, that Elf Beauty, I can't wait to look at that. That could be something pretty good there. We'll see. That's why we do the numbers.
Yep.
So let's dive into it. And no surprise to us that there's a glut of apartments on the market. You know, I saw the potential for this oversupply happening in San Diego. Gosh, at least a couple years ago, it seemed everywhere you drove, within a very short distance, you would see construction of new apartment buildings. And it's not just here in San Diego. There's a glut of apartments that's happening around the country. With the dynamics of supply and demand, if you're looking for an apartment today, well, you may be in luck to get a good deal on that apartment you've been waiting to get.
Just very simply, high supply, less demand. Hey, that's a great thing if you're a buyer, not so much if you're on the other side of the coin.
That's right.
But I mean, we're here in Scripps Ranch is where we do the show. That's where our office is. Mm-hmm. And I'm just thinking, I mean, I could, maybe back in my day, throw a rock and hit an apartment building one way and then throw it the other way and you hit another apartment building. Now, that's a little facetious, obviously, but literally you have the apartment buildings that's right off Carroll Canyon, and you have the ones that are off Mira Mesa Boulevard. They did a huge expansion. Then you go down the freeway just a little bit. There's one now that's off the side of Poway Road. Then you have one that's right by the Vaughns off of Scripps Ranch, and you're like, holy cow, and that's just a microcosm of it. I mean, they're everywhere. It's just crazy.
And Chase, how many of those apartment buildings do you think are funded with private equity?
Gosh. Yeah, I mean,
we'll find out in a few years.
Yeah, I mean, it'll take a few years because you won't know until you know. And I mean, the reason it's concerning is because if you look in September, rental rates had the steepest drop in more than 15 years. Again, not a problem if you're the consumer, but again, the landlords are the ones having the issues as they're now having to offer months of free rent, I love this, gift cards, free parking, and some are even paying for your moving expenses just to get you to sign a lease. You may want to play hardball because in some areas, they'll even cut the rent on top of all those incentives. In September, 37% of rentals had agreed to concessions like months of free rent. And I bet you a lot of people that aren't getting the free rent are the people that aren't asking for it.
Yeah, I mean, you got to kind of ask for it and say, well, hey, if you don't give it to me, well, I can go within a mile and find another apartment very easily. That's maybe nicer than yours. And so you got to understand supply demand. And there's a lot of supply out there, as you said. And you got to be willing to tell the person you're dealing with, like, well, hey, if you don't give me the deal, I've got 10 other choices I can do right now. So it's very important. And you may ask, well, what caused the problem for landlords is during the early years of the pandemic, developers could not begin building apartments fast enough, especially in the Sunbelt area where there were major population migration. It became the biggest apartment construction boom. And listen to this, 40 years. I mean, that's a long time, 40 years. But because of the delay of construction permits and labor shortages, well, development took much longer than they had hoped. it seemed no one looked around to see all the apartments going up, and now they're all competing with each other for those renter dollars.
And I do wonder now. I mean, you look at, again, all these newer apartments. What are the people with older apartments doing?
Oh, wow.
I mean,
Good point.
we talked about this a couple of years ago with office space, right? Well, your Class A buildings are doing okay, but your Class C buildings were really, really struggling. Nobody wanted to go there. Are we going to see the same problem now with this huge glut of apartments where it's like, your Class C, that's not how they classify it, I don't believe, but your older apartment buildings, how are they going to be able to compete with the newer buildings that are also offering maybe comparable rent? It's like, well, why would I pay $100, let's say less even, to live in this older building? I'd rather pay the $100 more to live in the newer one with all the nice amenities. And I mean, apartment living can be great, but I don't know what those older apartment complexes, those owners are going to do to compete.
Well, hopefully they don't have a lot of expenses and they can really cut the rents a lot, because that's the only way you're going to keep those people, because you get all these other nice things, this nice shining apartment building. Why would I pay the same price? So they got to cut their rents dramatically, those old apartment buildings, which, again, good for some people that can't afford it. College students and many.
Yeah, I mean, but this is the opposite of what you want.
Yeah.
Landlords generally want to increase rents, and they're hoping maybe by the end of 2026 or at least sometime in 2027 that could occur. But I just don't think they're factoring in how many apartments are online, with, again, more still to come. And based on the current apartment inventory and new apartments that are coming, renters could be in for a lower rent, maybe perhaps until even 2028. And I think that is something to definitely keep an eye on.
Yeah, and this is also not good news for the housing market, because rent for houses will be the next to fall. And then people will have to factor in the affordability of renting versus buying a home. This would also likely hurt the demand of buying rental properties as an investment. If you can't get as much rent as you thought, why are you going to spend all this money on a rental house? A lot of people do second properties. Oh, that's great. I can do, rent this house, Airbnb, and so forth. A little bit different market there with the Airbnb, but still with the rental properties, why is someone going to spend a high price for a house when you get maybe $1,000 less, maybe more, to live in a decent apartment with a lot of amenities? I mean, it's going to create the whole market.
Well, then, as you said, yeah, I mean, if you get $1,000 less on the apartment, well, then the home has to then maybe cut their rent, because you're going to have people that have their preference of living in a home over an apartment, but at what cost? So then maybe the home has to cut by $500 a month.
Yeah.
But then the people that have real estate, I mean, you really got to be cognizant of this. You have to understand what's going on in the market, because you could be, I guess I'll call it blindsided, where all of a sudden you were kind of factoring into your investment thesis that you'd be able to raise rents at, I'm just going to say 3 to 5% each year. And that's one of the reasons, well, I'm going to buy real estate because I can increase the rents. And maybe you can't. Maybe that doesn't make it as strong as an investment as you had initially hoped. And I do wonder, as you said, with private equity, a lot of times when they buy things, they bake in all these assumptions, right? Well, they're going to bake in the interest rate that they're going to think they can get. They're going to bank in what they think the potential vacancy rate is. They're going to bake in what they think the estimated rental rate is. And all of a sudden it's like, oh, shoot, we were off on 2 of those things.
Yeah.
Now that changes the complete dynamics of the investment. We over-leveraged ourselves, and that's where the issues can ensue with private equity.
And I think it's public information, but I would bet that the builders, they're trying to get these apartment buildings built and rentals and so forth, don't go because maybe they can't get it. But the building permits, how many building permits are going to be coming online? I think that's public information.
It is. Yeah, you
Okay,
have building permits and housing starts that come out every single month. Well, actually, they will be coming out again every single month. The government shutdown has now finally come to an end this past week. But yeah, you can see, and they have multifamily versus single family within the subset of data there.
But if I'm going to build an apartment building here in San Diego, I would like to go down to the county recorder's office and say, well, how many building permits do you have coming online? And it takes a lot of research, but this is why I think many people invest poorly. They don't think ahead very far. Like, oh, it'd be so great to have this apartment building. Oh, I can make it so beautiful. You forgot about the upcoming competition.
Or they look at like saying, okay, there's this apartment down the street that they're 90% full with, X amount rental rate. Well, I'm just going to build one too and have the same assumption. Well, that's a stupid assumption, because then you're going to have to compete with them, which competition, again, is great for the consumer, not so much for, I'm going to say, the business or the landlord.
Well, speaking of, I'm not going to say stupid. I guess I'll say silly. China is no longer just manufacturing. They are also beginning to innovate. For many years, innovation was generally done here in the U.S., and we would have the product manufactured in China. Well, China is no longer happy with this arrangement, and its research and development spending is up nearly 9% a year, well above the 1.7% per year spending here in the U.S. That's a problem.
Yeah, I mean, you look at the numbers here, and it's, I'm going to say concerning. I mean, 2024, China filed 70,160 international patents, which was above ours about 54,087. So again, about 16,000 more in China versus the U.S. there. China also seems to be more advanced in robotics, installing 300,000 industrial robots in 2024 compared with roughly, this number scary, 30,000, so 10 times the industrial robots here in the U.S. It has also been noted that when it comes to worldwide sales of electric vehicles, I mean, China just dominates this market as 66% came from China.
And you know what just struck me too? I mean, we used to go to China for their cheap labor. That's why we could get things done much cheaper in China. Well, now with 300,000 industrial robots, their labor is going to be even less, and they're getting ahead of the curve on that. And it's just something that I was
going to say, too, on the robots, I mean, this is one thing, again, with Tesla, right? We kind of talked about Tesla, I think, in our newsletter last week about how, we'd buy it if we weren't value investors potentially, because it's exciting. But the humanoid robots that Elon is trying to create, and he says there's this huge market for, I don't know any other, major players here in the U.S., but I think it was like XPeng or one of the Chinese companies. They showed the robot that they're working on, and I think it's pretty scary too.
Yeah.
And I think that is, again, competition that people aren't assuming if you're a Tesla shareholder.
Right. Well, while these developments seem positive for China, the country is still experiencing problems with a slowing economy, as they have seen fixed asset investment decline and a slowdown in the real estate and the retail sales. The population of China has also declined. This surprised me over the last 3 years, and the real estate market, not surprised by that, over the last 4 years has really taken away a lot of household wealth. And I was surprised to see, again, a decline in the population. I know they did that 1 or 2 children.
I think it's one child.
One child.
Yeah.
But I was surprised it's declined over 3 years. And then the real estate market, I know that's been a problem for years, and it's not turning around.
And I do believe, I don't know the politics in China that well, but I know it's a communist country. I think their immigration policies are going to be a little bit more strict than what we have here in the U.S.
That's true.
And I got to say, for a country that thinks long-term in many cases like China, I don't have any idea why they did that one-child policy. That doesn't seem like long-term thinking to me. But another thing that is hurting China is debt. And this is something, again, that really can hurt people, hurt companies, and hurt countries as well. And that public and private debt continues to climb rapidly, which is becoming a problem. It is estimated that China is spending around $85 to $95 billion on AI capital spending, but yet their economy, well, it is continuing to struggle. And as noted by China Merchants Bank, which talked about an 11% decline in consumption among customers, and retail loans are also now under pressure. So again, a lot of excitement, but also some serious concern there too.
It's funny, you mentioned about the immigration, not many people going to China. Who wants to go to a communist country?
That's a good point.
Yeah, they don't have to have the barriers up because no one's knocking their doors getting there. Now, here in the U.S., yes, a lot of people want to come here, but in China, no, thank you. We'll go somewhere else. We don't be part of a communist country. But China's exports to the U.S. are down 27%. Why? Well, the tariffs. But worldwide, their exports are up 8%. It was recently reported that Beijing banned foreign AI chips from NVIDIA, Advanced Micro Devices, and Intel from government funding data center build-outs. Currently, China cannot pass the U.S. and its allies in producing the most advanced semiconductors, but they're making very good progress in developing mid-level chips and parts of the AI ecosystem. The U.S., we have to continue to forge ahead, because if we rest and just sit on what we've done in the past, China in years to come will be the dominant world power and will be speaking Chinese. And I've said this before for years. We are falling behind, and we are so concerned on certain things that don't matter. And I won't go into details, but it's like we've got to produce. We've got to work hard because we will be speaking Chinese, or our kids will be speaking Chinese in 10, 15 years.
I remember when we did the Dr. Phil show, you got ridiculed for that. They said it's Mandarin. Is the
I know, that's right.
But illustrating the point here of, we have to be very careful with China because, I mean, they don't want us to be better than them, right?
No.
It's good to have competition because I think it forces advancement, but we got to compete because China is coming to the table to compete as well.
And we've got to work hard. We've got to invest. And this thing of, 3-day work week, 4-day work week, like, no. I mean, China's working their butt off. And, we're jogging. They're running full speed. So we got to work harder. But let's talk about something that also was a surprise when we discovered it, but our large hyperscalers like Meta, Microsoft, and Alphabet inflating their earnings. Well, Michael Burry, who was made famous by The Big Short, made the claim that some of America's latest technology companies are using aggressive accounting to pad their profits. He believes they are understating depreciation expenses by estimating that chips will have a longer life cycle than is realistic. Investors are likely aware of the huge investment these companies are making in AI, but, and there's a big but here, they likely don't understand how the accounting of these investments work. And it makes so much sense because the chips, I think they're obsolete in 6 to 12 months. They become obsolete very quickly. But if your depreciation schedule is much longer, well, that's what we got.
Yeah, that's what we got. Yeah, and I mean, to kind of give you an idea, I mean, if a business makes an investment in these semiconductor servers of, let's say, $100 billion, that doesn't hit earnings when the money is spent, as under generally accepted accounting principles or GAAP, they are instead able to spread out the cost of that asset as a yearly expense that is based on the company's estimate of how rapidly that asset depreciates in value. The key word here is the company's estimate, not
right.
What is actually true. It's what is the company's estimate. From what I've seen, these companies are generally depreciating their NVIDIA chips over 5 to 6 years. And this does seem to be a stretch considering NVIDIA is on a 1-year chip production cycle. And the technology, I mean, it's just changing so quickly. And kind of give you an idea of how that works, right? So that $100 billion investment you make, again, that doesn't hit your P&L in year one. What's going to hit it is the depreciation. So you have a 5-year period, let's say, to make it easy. It's $20 billion a year potentially instead of a $100 billion expense. And those are, again, just kind of numbers to help illustrate the point. That's not exactly what's going on, but kind of give you an idea. It helps you spread out the expense on your P&L. And that's why Burry is saying it's inflating the earnings of these companies, because he thinks it's a much quicker cycle.
And that's why people say, buy the dips, buy the dips. They don't understand what's going on behind the scenes. And we're not saying it's going to happen tomorrow. These are things that build up over time. And then eventually it drops 30, 40, 50%. People scratch their head. What happened? We talked about this back in 2025 because of accounting. And people don't understand. I mean, we both have degrees in accounting. That's why when we invest, we look very closely at the financial statements. Doesn't mean we'll be right today, tomorrow, sometimes even next year. But long term, you will be right. So let's talk about Burry. He does estimate that from 2026 through 2028, the accounting maneuver would understate depreciation by, I love this number, $176 billion. And if Burry is correct, hyperscalers will have to write off AI CapEx as a bad investment due to depreciation useful life mismatch. This would then produce a major hit to earnings. While I remain a believer that AI, it is here to stay, I do believe there'll be some big-time losers in this space, giving all the money that's being spent. And here's another thing we've talked about. We've talked about different things with the dead fiber optic cable, back with the internet boom and bust. Here's another thing that's going on that you don't see it, but it's there.
I mean, one thing I wonder is, data centers are so hot right now, is years from now, could we have ghost data centers? People are going to say, you're crazy, but, right now, probably not. I think our data centers are probably undersupplied, but it's kind of like the apartment buildings we talked about, right? Everybody wants to be a data center, so they're building them. If we come to an overbuild on it, that's where you have these ghost data centers, and it could be a potential issue. And I'm not talking next year, obviously, but maybe 5 years down the road, it could be something to consider, as you said, with the fiber optic cables there.
Dark cables, they call them dark cables.
Dark cables.
Yep.
But the thing that we talk about, as always, is be careful chasing that hype, as I do worry the fallout for some of these companies could be larger than many think is possible. Burry has also warned this year that AI enthusiasm resembles a late 1990s tech bubble, and recently disclosed put options betting against NVIDIA and Palantir. This is interesting as well. He did state that more detail is coming November 25th, and that readers who love this should stay tuned. I know I'm definitely curious what other information he has here. As this was a great point that not that many people were talking about.
And I wonder why November 25th. What is that date? Is he just being a great marketer, kind of teasing about, but I'm now kind of curious. November 25th. When is Thanksgiving?
It's that week. I think it's actually the day before Thanksgiving.
So he's going to spoil Thanksgiving for
yeah,
people,
maybe.
Right? But on a separate note, we got to talk about Microsoft, Amazon.com, Alphabet, and Meta platforms all alone could combine for capital expenditures of $356 billion this year. That's up 56%. This comes from Bank of America. That compares with $904 billion, up 5% for the rest of the S&P 500. Again, we always give you solid numbers on a Smart Investing show. It's not like hype. It's not like, no, we give you solid numbers to kind of make sense for you.
And if my math is just quick math right on that, that's 4 companies essentially, 1, 2, 3, 4, accounting for about 25% of all the CapEx in the S&P 500.
Yeah.
And this is just something when I look at it, again, there will be winners in AI. And I'm going to tell people we will be wrong because we're saying we don't want to invest in this space because I don't know who the winners will be.
Right.
But we're going to tell you, well, maybe that one's not a winner. And it will be a winner, right? There's going to be winners that we're not predicting because good luck doing that. But the problem is I just can't foresee who's going to win here because, again, using this example, if you're using a 5 to 6 year useful life for these chips, well, then that would hurt NVIDIA because you wouldn't need to replace the chips for 5 to 6 years. Point. So after this build out is done, maybe a year or two, well, then what is going to happen to NVIDIA chips for, let's say, a 2 to 3 year period? Now, if it's the other side of the coin and you need to replace the chips every year, that's great for NVIDIA. But these hyperscalers, that then means they are now having to spend $300 billion, let's say, on capital expenditures every single year. And a lot of times these tech companies, they've gotten premium valuations because they aren't CapEx heavy. And when you talk about now you're stacking $300 billion every single year, now that depreciation is going to start mounting at a very, very quick rate and your earnings are going to have a hard time growing. I mean, it's just when you start logically thinking about it, it's like not everybody can win.
It's a snowball going up the hill because those expenses will increase. Because you got to write off the CapEx because you did that. Then you can buy new chips that are more expensive, and probably you won't be able to do a 5 or 6 year life on those. Like, no, the CPA should say, no, you get 1 to 2 years. What? That's going to be a big write-off. Well, they're coming. The train is coming to a difficult period, and it could be. It's not going to be tomorrow, but it's going to be longer term. And this could cause and that's why he mentioned the tech boom and bust. Things happen, and nothing goes on great forever, and that's why we look at the numbers because, and it doesn't mean we know the exact date, nope, but we know when things don't look right.
And I do have a note. I want to write a post about the Nifty 50 because a lot of times people say, oh, it's not like the tech boom because these companies actually have cash flow and earnings. Well, the Nifty 50, that is going to be, I think, a great history lesson for people to look back on because that was your Gillettes, your companies that weren't super exciting, producing strong cash flow, that they got way overpriced. I think what we're in right now is a combination of the Nifty 50 and the tech boom.
And I think very similar things are said. Like, oh, don't worry about it. Just buy it. Just buy it. Goes down, buy it. Goes down, buy it. Goes up, buy it.
They were the forever stocks.
Yeah, forever stocks. And learned a lesson in 73, 74 from that. Yep. So, again, we're trying to be ahead of the curve for you, make you a smarter investor. Let's talk about a company here. You want to dissect a company?
Let's do it.
All right. Let me, Axon?
Axon.
That's the way it looks, but I want to add something to it. But Axon is the company. Actually, Axon Enterprise is the full company name. Symbol is AXON. They're in the aerospace and defense industry. Float on the short side, only 3.2%. 84% institutional owned. PE ratio, well, not a good start here. 174 versus 53 for the industry. Price to sales, wow, also expensive. 17.8 versus 2.8. Price to book value, 14.4 versus 7. And price to cash flow is 187 versus 31. Wow, these valuations are just ridiculous. I don't know how to say it. And then when you look at the earnings over the last year, they're down 17.9% when the industry is up 4.9%. Sales, this could be why people are paying up for it. Could be a dangerous thing, but sales were up 31.8% for the last year versus a decline of 4% for the industry. Analysts hyping this up, a 5-year earnings per share growth estimate 52.3%, while the industry is a negative 27. They do not pay a dividend, so nothing there. Let's see the balance sheet. Current ratio looking very good, 3.1 versus 1.5. Debt to equity is in check at 0.7 versus 0.8. We do see a net profit margin of 10.1 versus 5.7. That's a positive. Return on equity not so good, 8.5% versus 18.3% for the industry. And the free cash flow is only $145 million versus $2.4 billion for the industry average. So this is kind of scary, and I don't know why we picked this company. I think I know it's a great company, and we're going to more to talk about it, but gosh, these numbers look frightening to me.
Well, I mean, it's pulled back quite a bit, but I think it just got so crazy expensive. I mean, it looks like last week the stock plunged about 19%, and it was pre-market trading. I'm not sure how it ended that day, but it was because of an earnings miss. They had sales that they came in nice, up 31% from a year earlier. So again, it's a great growing company, but adjusted earnings came in at $1.17, which was short of the consensus of $1.54. And that's what can happen with these hype stocks. You come in with a miss, I mean, you can just get taken down so quickly. I mean, you look at the current price here, $554.37. That 52-week high, $885.92. So we've seen a pretty substantial pullback, which was like, hey, maybe you could get a good company here on sale. But I think this thing just ran way too far ahead of itself. And especially you look at even still what you're paying for the future earnings. You go out to December 2026, estimated earnings per share, $7.56. I mean, that gives us here a target sell price of just $125.50. It trades at over 73 times those future earnings.
Yeah, and you don't know how long the hype lasts. And yeah, congratulations, made money on it. But here again, we come back to what you're paying for a business. It's well overpriced, nothing great in the future. Doesn't mean the stock won't rebound somewhat. But again, the whole reason why you buy stocks or invest in stocks is for the earnings. And the main thing you don't want to do is you don't want to overstate or overpay for those earnings. That's the other big thing.
Yeah, I mean, this is almost like NVIDIA type returns. 10-year return here is almost 3,000%.
Oh, wow.
You go back to the max chart here. You go to 2001, it looks like, is when this company was public. It's almost 100,000%. I mean, you've done so good in this company, but gosh, those valuations are crazy. And as I said, I mean, I have a friend that's a cop, and he loves the products that they produce.
Great product.
And I have a friend that is in sales for them, and he always tells me about it. It's like, that's crazy. They have like body cams, and they have like AI, right? So that's probably why they're getting the premium here, the AI transcription services to help kind of officers reduce the amount of time that they're having to write reports. So, I mean, it's a great business, but gosh, is that just an expensive stock right now?
Yeah, the hype comes in, overprices the stock. Average investor goes in like, wow, this has done great. I better invest into it. They buy high, and then 3 years, 4 years down the road, oh gosh, I lost money. Stocks are so risky. Yeah. Stocks aren't risky. You do risky things. All right, that wraps up the first half of the show. When we come back, we got our financial planner, Harrison Johnson, talk about 50-year mortgage. Helpful or hurtful? We'll talk about that. So stay with us. You'll listen to Smart Investing Show with Brent Chase. We'll be right back. All righty. Welcome back to the Smart Investing Show. I forgot to promote the newsletter when we finished up because we talked about, the glut of apartments, the hyperscalers with accounting, China. That all comes from our newsletter. It goes out every Friday at 5 o'clock by email. Also in that newsletter, you'll see, does the U.S. need strategic petroleum reserves? The new Paramount Skydance, loses moneymaker Taylor Sheridan, which is quite amazing that they lost that guy. That's terrible. Ford's electric truck knows the F-150 Lightning may be coming to an end. President of Microsoft sells 38,000 shares of stock. And protect yourself from AI scans with a code. The job market still looks strong. And then also, I think in that is going to be Harrison's topic, but we'll let you talk about that in a minute. So let's change that. Oh, you might get the newsletter. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. It is free. Just got to sign up for the newsletter at the website, smartinvesting2000.com. Well, with us is Harrison Johnson, CFP. Harrison, thanks for being here today.
Always.
We got a topic here that is, when you first look at it, like, what 50-year mortgage, helpful or hurtful? That's a long time to pay. What do you got? What are you talking about here?
So this is something that's been in the news a little bit recently, and I thought it'd be kind of fun to talk about. We have 30-year mortgages, 20-year, 15-year, 10-year. So these are these mortgage terms. And the longer you have a loan, the lower the monthly payment is. So there's some people thinking, well, maybe if we just offer a 50-year mortgage, then that'll bring payments down a little bit and people can have a little bit easier time affording houses. Now, some of the critics that argue against this say that, well, if you have a 50-year mortgage, that means you're going to pay a lot more interest to the bank over that time. And right now, the average age of the median age of a first-time home buyer, I think, just hit 40. So if you're 40 and then you get a 50-year mortgage, you'll be 90 by the time it's paid off. So people are saying, you'll never be paying this off. You'll be paying it off for the rest of your life. And while those two arguments, paying a lot of interest and it's way too long, they might be on the right side of this conversation. Those two arguments I don't think are good arguments because how much interest you paid to a bank over time, I think is irrelevant. The interest rate is what matters because if you can get a low interest rate, I don't care how much I'm paying to a bank because I would rather invest money in something else that's going to earn more. Just like people right now that have 30-year mortgages locked in at 2%, yeah, they could save interest by paying it down faster, but they shouldn't do that because there's other things that invest in that make more than 2%. And then the other thing is, with the time of this, a mortgage lasting 50 years, most mortgages today don't last the whole term. They don't go to maturity because the house is sold or the mortgage is refinanced or people pay it down quicker. So those are not good arguments. And, a 50-year mortgage, at that point, it's really not that different from an interest-only loan. Like HELOCs, for example, are interest-only loans. So, this monthly payment is a little bit smaller. It gives you more flexibility. So if this were to be something that gets rolled out, smart people could potentially use this to have a lower payment and then invest in more in other places. However, I think in practice, most people wouldn't do that. So most people, if this came into fruition, would use these mortgages and they wouldn't be saving money in other places. And so they would then not have as much wealth accumulation because they're paying these loans down slower while not accumulating assets. So overall, I think this probably would not be a good idea, but that doesn't mean that it can't be used well. I think just most people wouldn't use it as efficiently as it could be.
I think it's like a very sharp knife. You can do a lot of things with a sharp knife, but you can cut yourself and hurt yourself as well.
Yes.
And this is where, again, a good financial planner can help you because I like the idea that you're going to pay less per month. Yeah, 50 years is a long time. But if you're wise and you now say, take that difference and you say, well, now I can max out my 401k, I'll have a great retirement. It used to be you want to pay your house off when you retire, you don't have that. But if you do the opposite and you have a great 401k and at retirement, you've got $1 million, $2 million that's going to provide great income, you don't care that you got that payment. You're going to have to pay it anyways. And I believe it's probably changing now because such low mortgages. I believe that the average holding for a mortgage was about 7 years.
Yeah, last I looked into it, it's about 7 years, which again, the lowest term mortgage, I don't think there's 5-year mortgages out there. I think the lowest you can get is a 10. So even those don't go to fruition. So 50 years, whether it's 30, 50, whatever, they're not going that long. And a mortgage that lasts 50 years, for example, all that means is you can pay it off as quickly as you want to or as slowly as you want to, up to a maximum of 50 years. If you want to pay it off in 30, you just have to pay a little bit more. But if you can get a low interest rate, interest rates have been coming down. If you can get a low interest rate, there's no reason why you can't use this as a good tool. Like you're saying, Brent, you can use a knife to cut things or you can cut yourself. If you use it as a tool correctly, it can be helpful. But a lot of people don't do the right things with their finances.
That's why they need a financial planner that knows what he's talking about.
I was going to say 2 thoughts on kind of differing sides of the aisle here. Is the first one is obviously you talk about a lower payment, and unfortunately, I think too often people look at the lower payment like it's a lower payment, that's great. But again, if the interest rate's higher, substantially higher, then it's not great. Like I see a lot of times now with like a firm and these buy now, pay later things. It's great if you can get the 0% interest, and I highly recommend using it if you can get the 0% interest. But other times you see in there, it's like, oh, I can spread it out over 24 months, but the interest rate's like 14%. Don't do that,
right.
So if the 50-year mortgage comes out, I'm just going to say the 30-year fixed is, let's just make it easy, 5%. If the 50-year fixed is 7%, it's like, that might not make sense. That's, again, where you have to break down the numbers to see what makes the most sense. Now, kind of the other side of the coin, as Harrison already brought up, doesn't know if he thinks it's a great idea because, people won't use them properly. And this is kind of where this whole concept, and I hate this term, but it is so true, forced savings. People are their own worst enemy.
Yeah.
And that is one thing I'm going to say that's beneficial about real estate is it does force people to actually build equity in something. And they do it without even realizing it. And doing this 50-year mortgage, again, the wrong person that doesn't understand things, they could be all of a sudden 70 years old, 30 years into the 50-year mortgage, and they have no assets. And then they're forced to sell the home because they still owe a ton on it, and it could be detrimental. We've seen people before where they retire with nothing but their home, and it's an asset that, if you can't afford the taxes, the insurance, and now a mortgage for another 20 years, you could be out of luck. So, that's where, again, coming up with a good plan and utilizing these properly is beneficial. But if you don't, it could be terrible.
Yeah. And with mortgages, like Brent, you have an interest-only payment on your mortgage. So it can be used correctly. That means you're paying no principal.
Yeah.
So you're paying that into infinity.
Yeah. and I'm fine with that because what we talked about is that I invest my other money.
Right.
I do fine. And I know that house will appreciate. And again, I'm only expecting, I've said this before, if in 10 years my house is up 50%, I'll be thrilled. But I didn't have to spend more for it. In the meantime, my investments grew much greater than that. So I can provide income, and I'm not going to retire, but if I want to retire, I can provide income to pay that mortgage. And that's what, but you got to be disciplined. If you're not disciplined, as Chase, you said, there's going to be people out there, they're going to think they're going to do it, and they don't. And then they really hit retirement. They got no other assets, and they got to sell the homes. They can't make payments.
The other thing I'll say on this is the whole point of this even being talked about is trying to make housing more affordable. Well, having a 50-year mortgage as an option is not going to bring house prices down. If anything, they'll stay the same or even go up a little bit. So in that regard, to me, it doesn't seem like it's addressing the root cause of unaffordability. If it's used correctly, it could be helpful, but I think, unfortunately, a lot of people wouldn't use it correctly, and then they'll complain about
Blame
it.
the government.
And I'll put you on the spot here. You probably didn't do it, but if you had somebody coming in and asking about it, you probably do a comparison what your payment is for a 30-year mortgage versus a 50-year mortgage and how much you're actually saving in the 50-year. I don't think it's going to be like half.
It's not. I mean, it's depending on the size of the loan and the interest rate, it's a couple $100 a month potentially. So it's not groundbreaking, but an extra couple $100 is an extra couple $100. And really, if you can save an extra couple $100 into your 401k or into an investment account over 50 years, that'd be a lot. So
yeah, and I like the interest only loan obviously because it's just I'm paying the interest, but again I can invest the money other places and do better than I would paying off a 5 or 6% loan.
Yeah, absolutely.
So, yeah. Well, Harrison, thank you very much. We appreciate it. Great information. And do people know if they should get a 50-year or not?
Well, right now it's not possible. They do have.
We're talking about it.
They do have 40-year mortgages out there, and for jumbo size loans, they actually look pretty attractive, I think.
And and it's not a one fits all. It depends on the situation.
Depends on the situation. Yeah, absolutely.
Here's your number real quick.
Yeah.
Using the median sale price of $415,200, the current interest rate of about 6.3%, a 30-year fixed loan with a 20% down payment, monthly payment of just principal and interest would be $2,056. If you raise the length to 50 years using that same interest rate, which again wouldn't be the exact case, the payment would be $1,823, a savings of $233 per month.
Yeah.
So it does add
10%.
up, but yeah.
That's only on a $415,000 purchase price.
Yeah,
So
and
if
that's
you bought-
20% down, so it's 80% of that.
There's a lot of $450,000 homes in San Diego, right?
Yeah.
Harrison, thank you very much. Appreciate it.
Thanks, guys.
Again, that's Harrison Johnson. He is our financial planner. He is a CFP. If you want a free consultation with him, give him a call on the phone, 858-224-0004. Again, that's 858-224-0004. Again, set that free consultation here in the office. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send an email, and he'll get back to you and set that free consultation with him. All right. We're going back to the companies here. What one are we doing here? Zoetis? that the way you say it? Am I saying that right? Zoetis?
I'm going to go with that. Yeah, that sounds good.
Okay, that was, we believe, a spinoff from Pfizer years ago.
I just confirmed 2013 is when Pfizer spun it off.
Okay, all right. You know, and that was, I remember when it came out, like, wow. And they're it shows here a drug manufacturer, specialty and generic, but it's basically a pet drug, right?
Yeah, they focus on animal health.
Okay. All right. Well, let's see. 2% short on it. 99% institutional owned. That means a lot of people do not own this individually. Not a bad start. The PE ratio is 20.4. Oh, the symbol is ZTS. I think I forgot the symbol. ZTS or Zoetis is the symbol. 20.4 versus 52.8 for the industry. Price of sales are high, though, 5.8 versus 2.1. Price of book value also high, 33.4. That's price of tangible book value versus 25.2. And price of cash flow high as well, 18.5 versus 13.3. They do have a PEG ratio of 1.9, which is positive with nothing compared to the industry. So hopefully when we get to the earnings and the sales, we see some high numbers because you are paying a lot for the earnings, sales, book value, and cash flow of this company. That's what we get. Earnings per share of last year are up 11.7% when the industry was down 7.9. Sales not too exciting. They were up 2.7, but compared to the industry, that was down 9.1%. And the 5-year EPS growth estimate from the analysts is very nice at 10.5 because the industry, they're expecting a decline of 5.4. Now, they do pay a dividend, not a bad dividend, 1.7% using 33% their earnings to pay that out. We do see on the balance sheet, they got a current ratio of 3.6. That compares to the industry at 2.7, but a lot of liquidity there appears to be happening. Debt equity, not great. It's 1.4, and that's where we start getting worried. We don't want it much higher than 1.4. That's double the industry at 0.7. Surprised on the intangible assets, only 25% versus 35%, so not a lot of intangible assets there. Their net profit margin is very good. I would double check this looking at the income statement to make sure it says high, but it shows 28.2 versus 4.1. I'm just wondering if the profit margin on animal drugs, I'll call it, is so much higher than it is individuals or
sure
people.
It is.
Yeah, I guess so. Yeah, people pay anything for the pets. Return on equity is very good, 49.1 versus 7.3. Free cash flow is very good, 2.2 billion, about double the industry at 1.1 billion. Chase, what do you got going forward?
Yeah, so current price here for, again, Zoetis, ticker symbol ZTS. It's $120.82. 52-week range. The low here, $117.26, and the high, $181.85. I mean, the stock's been under pressure this year, down about, I'd say about 26% over the last 1 year. It's now down about 30%. 5-year return, not good either, down 26%. 10-year return, though, you bought it 10 years ago, you're up 156%. So, a great first 5 years and then a lackluster after 5 years.
And with that dividend, it's 193% with a dividend. So...
But one thing that is actually weighing on them is stock fell about 12% last week, hit a 52-week low at that point. They lowered their full-year revenue guidance, which is something you don't want to see in a growth stock. Revenue is now anticipated in the range of $9.4 billion to $9.475 billion. The prior guidance was $9.45 billion to $9.6 billion, so they went well below that initial low end of the sales range. And, even with the pullback, I mean, the stock's still expensive. You go out to December 2026, estimated earnings per share here, $6.81, gives you a target sell price of $113.05, still trading at nearly 18 times those future earnings. So you're getting now less growth at a high valuation. I mean, this could be problematic where it could be in limbo land in between a growth stock and a value stock. And if that occurs, that fall could be much worse because value investors aren't ready to buy it yet, and growth investors, you're not getting that growth anymore.
And as I said, only 1% is individuals, the rest is institutions. So institutions seem to like this, which is surprising to me because it's just, I thought it'd be the other way around because people love their pets. Like, oh yeah, this would be a great investment. But the individual investor is not really participating here. And we held, well, actually, I think you were probably in high school back then, but we did held Pfizer back many years ago.
That was college. Graduated 2011.
Oh, okay. Well, I think it was before that.
Yeah.
We bought Pfizer. Did very well on it.
Oh, okay.
I remember this spinoff, and we sold it because it just didn't look very good. So, I mean, I do remember this and think, would this be a good thing because of the fact with the drugs for the animals and so forth? But I guess over 10 years that it did good, but not a buy now.
Yeah.
Shoot. I was kind of hoping for that one. I thought that'd be pretty good.
Yeah, me too. I thought there was some potential there, but looks like nope.
All right, let's switch over and talk about beautification. We're talking about Elf, and I wonder where they get that name from, because when I think of Elf, I think of Sephora, I think of what's the other, Ultra Beauty. Elf, I mean, I guess the symbol is, actually says the name is ELF, Beauty. I guess that's the full name of the company. So, okay, that makes sense to me. But let's take a look at, they are considered the household and personal products industry. What do you got?
I was very curious what ELF stood for because you asked. Eyes, lip, face.
Oh, of course. Now it makes sense. Because when I think of Elf, maybe it goes to Christmas, I'm thinking of little elves running around with Santa.
Well, and it was followed by periods after each. So I'm like, it's got to stand for something,
Yes,
right?
yes.
So it does. And it is different. Like Ulta doesn't, Ulta's more of a store place, right? Elf is actually a producer, a manufacturer, or brand.
That they sell. You might tell us where they sell this at when you get to it. But they are, again, in the household and personal products industry. Symbol is ELF, same as the name. But short on the float is pretty high, 10.4%. That's when we get a little bit nervous. Institutional owned is 97%. Wow, PE ratio 52.6 versus 25.2. Price of sales 3.1 versus 2.6. Price of book value is 3.9 versus 4.9. Price of cash flow 25 versus 6.9. They have a nice PEG ratio of 1. Now, over the last year, unfortunately, their earnings are down 24.3%, while the industry is up 7.3%. The sales did climb by 13.8%, but yet the industry was only up 1.2%, so positive there. They get a 5-year earnings per share growth estimate from the analysts of 27.3%, but that's for the company. The industry is a negative 12.8%, so that's positive for Elf there. They don't pay a dividend. I'm disappointed on that. The balance sheet, current ratio 2.7 versus 1, so a lot of liquidity there. Debt to equity 0.8 versus 1.2, that's a positive. Net profit margin 5.9, not as good as the industry at 10.4. Return on equity not very good, 7.2 versus 27. Free cash flow not looking very good, 142,000 versus $7.7 billion for the industry. So don't like seeing that. What do you got going forward, Chase?
Yeah, so current price here again for Elf Beauty, their ticker symbol ELF, $73.51, 52-week range. The low here is $49.40 and the high $150.99. I did look up the all-time high as well, as I thought it was a little bit higher, and in June 2024, it did hit an all-time closing price of $218 per share.
Wow.
Now, the thing you look at is the stock is down about 41% this year. They dropped more than 31% after issuing disappointing guidance last week. So, I mean, the stock has really been hit again so far. And yes, where they sell, I mean, they're in Target, Walmart, online. It seems like they really try and sell more online than your normal beauty brands. They target that. But the interesting thing that I looked at is their target market is generally Gen Z, value-driven shoppers.
You know, and I take my wife shopping a lot. She likes going to Sephora and stuff, and she likes trying things, touching them, talking to the person. I don't know. We have Sarah here. I know she wears makeup. I mean, it would seem like makeup is something that you don't want to buy online unless you know what you're doing, because you want to test them. I mean, Sephora, I just get baffled. I go in there like, they all look the same to me. There's so many different products. How can you buy this online? I mean,
well, they are in stores. So,
Right.
you know, that's one thing. If you have a brand that you like and you use and you get the same product every time, I think it's okay to buy online, right? But you're right. Before you buy it the first time, you probably want to test it. But if you're getting the same one, because my wife, she'll get the same product that she knows online. And you don't need to test it out if you already have it. So I don't know if that's kind of their thing where they have the footprint of actual brick and mortar, but then also they try and drive more repeat purchases online potentially.
I hope my wife's not listening to the show today, but she has so much makeup, so many different things. It just boggles the mind. Like, do you use all those things? So I think it's part of going into the store. It's like exciting to get stuff and something new. Yeah, and Sarah's over there shaking her head. Yes, that's what it is. So I mean, you get something, but then you want to go back and, oh, what have they got new?
Yeah, and I'd be curious. I didn't look it up because ChatGPT said digital first beauty lovers is their one of their targets.
What?
Digital first beauty lovers, which is kind of ironic, right? Because you put makeup on to go out.
I don't know what that means. Digital first beauty lovers.
Yeah, so you're prioritizing digital shopping over brick and mortar shopping. And again, that makes sense as a Gen Z consumer. That's even younger than me as a millennial.
Yeah.
They're going to be much more likely to shop online than brick and mortar.
Wow.
But again, they do have that brick and mortar presence, and I didn't look up. I'd be very curious what their online versus brick and mortar presence is.
Yeah.
But the big problem with this stock, and this is just interesting to me, we've looked at now 3 companies that have just been, I don't want to say decimated, but hit quite hard.
Yeah.
Yet another one, March 2027, estimated earnings per share $3.55. We get a target sell price of $58.93. This stock still trades for over 20 times future earnings, even after a 41% pullback. And this is something that, again, concerns me with the market, is things just got so expensive that even pullbacks almost aren't buying opportunities in many cases because things are just so expensive.
They're still expensive. And that's why, I mean, we've been buying a little bit, made a couple buys over the last month or so, and we found some great companies that have a higher, much higher target price than what we paid for them. But you're right. I was hearing the same thing, like what? Down 40% and still not a buy. So a lot of things got hyped up, which means there could be a pullback in the market, which we talk about. But again, that's where value comes through. It will pull back somewhat, but not nearly as much. So what was the target sell price again? 50, you said?
Yeah, 58.93.
Yeah. So can't recommend a buy there at all, can we?
No.
Anything else you want to say on that?
No.
No.
Not a beautiful stock.
Ooh, that was pretty good. I got a comment. People can't see this on the radio, but on the podcast, TV, they can. Beautiful tie.
Thank you.
I like that color. I mean, is that new? I've never seen that before.
No. I only have about 5 ties. I'm what they call a minimalist.
I guess so. I think I got 50 ties. So I'm getting hungry here. So let's talk about a restaurant, Sweet Green. And we said here, no one we know has gone to Sweet Green. I think you said there's one in UTC.
I've been once.
Oh, you have been once.
I was not that impressed.
Oh, okay. Well, let's talk about the stock because you won't be very impressed there either, I don't believe. Sweet Green, their symbol is SG. They're a restaurant company in the restaurant industry. The short and the float, 31%. That's huge. We do see the PE ratio. Oh, no PE ratio means no earnings over the last 12 months. Price to sales, 1.1 versus 2.3. Price to book value looks good, 1.8 versus 15.4. But price to cash flow, 343 versus 15.8. So not so good there. They have no earnings growth of last year. Sales are up 2.4% over last year versus 6.8% for the industry. They do get from the analysts a 3.5% 5-year growth rate on the earnings, but industry is at 2.3%, so not too exciting there. Do not pay a dividend. The balance sheet, let's see, 1.3 on the current ratio. That is better than the industry. Debt to equity 0.9 versus 1. That's okay. Net profit margin, here could be the problem, a negative 16.5%. Return on equity, a negative 28.8 versus a negative 592 for the industry. Wow. And then the return on invested capital, a negative 15.1. Free cash flow, a negative 109 million, I think that is, versus positive 3.2 billion. This company, and I think we're going to talk about it because it's fallen a lot, but it seems to be another one that is just doing terrible, but no time for a turnaround.
Yeah, I mean, you look at the current price here for Sweet Green, again, their ticker symbol SG, $6.12. And I mean, you talk about the performance of it. I mean, the 52-week high, $45.12. 52-week low here, $5.14. Their all-time high, that was back in 2021. Closing price here, $53 a share. So, I mean, it's just really, you look at the chart, it looks like they IPO'd back in 2021. Looks like in November. And their all-time high closing price was in November of 2021. So one of those IPOs that did not work out for people. And unfortunately, you go forward for this business. You go out here to December 2026. They're estimated to lose 78 cents a share, so can't even come with a target sell price. This is one, again, that I just would not be buying. And interesting thing about them is I saw them on CNBC is that they're really trying to lean in almost to robotics. They have what they call the Infinite Kitchen. They acquired a robotic startup called Spice, and they built that Infinite Kitchen where they can supposedly make 400 to 500 bowls per hour, which is significantly more than a traditional manual line. But the problem is if you don't have consumers for 400 to 500 bowls, well, you're going to have an issue.
And also, too, you got to make good tasting quality food. You can make a lot of bowls, But if people don't like it because it doesn't taste good, I don't care how many you make, they're not going to buy. You said they're lacking consumers. So
Yeah, and I mean,
I'm going to have to go there maybe this week.
when I went, and this is a couple years ago, I was like, oh, it's kind of trendy little spot, new, had never been there. It sounded like it would be maybe healthy, and I think it is. I don't know.
It's supposed to be healthy.
But it was like, I just wasn't that good, and it was expensive. And I guess I'm not the only one that feels that way. I kind of was curious where they are in San Diego. I was looking up at a couple locations. This one down in kind of Mission Valley, it looks like Google star rating 3.8, UTC 3.4. The one up looks like one in Carmel Valley, 3.2. Not good star ratings for Google reviews.
But they're making those bowls pretty quick, aren't they?
Yes. I think instead of focusing on how many bowls they can make per hour, they need to focus on how to make their bowls taste good first.
And we bring this one up, and we don't know what these companies look like before we look at, but we thought maybe an opportunity because of the big pullback. But this also, too, explains why sometimes you just don't jump into something with a hype. You get burned out.
When I like kava tastes good, too expensive. This doesn't taste good and not worth the buy.
Not worth the buy. All right, there's a closing bell. Thank you for listening to Smart Investing Show. It is for information purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. And be sure to go to the website smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great educational information there. Sign up for the newsletter. Thanks for listening. We'll be back next week right here on the Smart Investing Show.